Okay, all right, folks, good to be with you. Here's a bit of info on my bio. I'm not going to spend a whole lot of time on it. The main thing to know, the first couple lines up there at the top, I'm a certification level 5 out of 6 internal certification levels with IRS, with the H&R Block rather. It just means that I'm not an enrolled agent, but I've taken all the other exams, risen to the other levels. And this is my 19th season of doing tax returns for H&R Block. Trying to give a little bit of order to the outline here today, calling it the A, B, C, D, and E of college and taxes. I'm going to start off with a conceptual overview of tax returns. One of the things that I've seen in the years of doing tax returns for people is most people never really get a handle on what exactly is going on in the tax return. I've reduced it down to 11 steps that are going on. I'm not going to go into them in great detail, but I want to expose you to them a little bit. So maybe it helps you get a little bit better understanding of what the whole process is about. I'm understanding that this is being recorded today. So if you don't have a chance to do screenshots of anything that you want to keep for future reference, go back in and check the recorded version and do some screenshots at that point. The next step will be talking about some general talk about tax breaks, the deductions and credits, what's the difference between them, because there are some college-related tax breaks. One is a deduction and 2 are credits. So you kind of have to have an idea of how deductions and credits all work to make sense of the college-related tax breaks. And just in passing, we'll mention that there is kind of a downside to receiving too much money in scholarships and grants. I'm sure everybody's shaking their heads at that and saying, no, 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 you can't have too much money. And all that means from a tax point of view is in some cases you may have taxable income arising from more free money coming to you than you spent on education expenses. And then having discussed those, we will talk for a couple minutes about extra money, which is to say the stimulus payments that are underway right now as a result of the economic impact of the coronavirus. So in the top paragraph here, the one that's left justified, I've tried to reduce the overview of the tax return to 11 steps. I'm going to try not to read everything on here today, but let me just go through these because these are kind of important. You've got a bunch of different sections and different things you're doing along the way to get down to the bottom line of whether you've got a refund or a balance due or you've just broken even. So there's an income section, and once you figure out what all your income is, you're allowed to possibly subtract some adjustments. Adjustments are just dollar amounts for various purposes that are getting subtracted from income. The result of that is a figure called your adjusted gross income. AGI is the acronym for that. Once you've got the AGI, you subtract any deductions, of which there's 2 primary varieties. And what's left at that point is taxable income. Obviously, you've reduced your income, hopefully, down to a lower amount that's taxable. Once you've got your taxable income, you multiply that times your tax rate. And I say parentheses tax rates because there are several different tax rates depending on how much taxable income you've got. Once you've done that multiplication, you've got a figure called income tax liability. Liability meaning that's what you owe before the next steps get factored in. And so the next steps are where you would subtract from that income tax liability non-refundable credits. We'll go into a little bit more detail of that coming up. You would add any other taxes you might have. Some more detail of that coming up too. And then you subtract any payments that you've made. The most common payment is you've worked a job and you've had income tax withholding taken out of your paychecks. That's one of your payments. But there can be other types of payments that count up on your side of the equation. And once you've subtracted those payments, what you have left is either going to be a refund that you're due from the IRS, or you owe the IRS some money, that's a balance due, Or in some cases, you might break even, meaning there's no refund or balance due. You're just filing a tax return to report that. All right, underline the next paragraph. If you learn only two things today, let them be that. And believe me, this is something that people, young and old, don't seem to have a handle on. And it's kind of irritating from a tax pro point of view, but it also just kind of shows up your ignorance if you start mixing up the terms. The return is the document. People come in and say, I haven't got my return yet. And I have to bite my lips and say, well, that's because you've already sent your return. What you're waiting for is your refund. So the return, the tax return, is the document that you're sending to the IRS. And the refund is any money you're getting back if you've paid in more to them than you end up actually owing. So I'd be happy for that to be your key takeaway from this session today. All right, so of those 11 steps, obviously there's a whole bunch of kinds of income, there's a whole bunch of kinds of adjustments, etc. So what I've tried to do on these next 3 screens, I think, is to drill down just to the ones that are the most likely to show up on the tax returns of college students. On the income side, wages, as I mentioned earlier, sometimes you have scholarships and grants that may end up being taxable. You may be doing some self-employment out on the side, and that would be taxable income as well. The kinds of adjustments that get subtracted from that income, if you've got self-employment, you may have certain expenses related to that, like if you're paying some of your own health insurance, a portion of your self-employment taxes, which is the Social Security and Medicare that you have to pay if you're self-employed. You may be contributing to a retirement plan. This would be a great time to start contributing to a retirement plan. The stock market is on sale right now, in case you hadn't noticed. Once you get into repayment mode on student loans, the interest that you're paying is actually an adjustment that you don't have to pay income tax on. And then one of the big credits or college tax breaks, rather, that we'll talk about in a minute is the tuition and fees deduction. And once you've done the math at that stage, you've got the adjusted gross income. I'm just pointing out here, please keep up with your info, keep up with your documents. If you're doing your own return next year, one of the identity confirmation steps is that the IRS is going to ask you for your adjusted gross income on the prior year return. So save your return. The next group of impact is coming from deductions, and there's really just 2 choices. You can itemize deductions, but these days that doesn't happen all that often as a result of some changes 2 years ago in the tax laws. So most people are taking a standard deduction, and as you go down the bullet points there, that's just a dollar amount that you don't have to pay income taxes on, and it's based on your filing status. So if you're single, the first $12,200 of income that you make generally is not taxable. Taxable would only be what's above that, subject to some of the other subtractions that we're talking about here. So you get your taxable income, you figure out what your tax rates are, looking them up in the table or letting the software on the computer take care of it for you. Result of that multiplication is your income tax liability, and that's your share of supporting the government. Before any credits, other taxes, or payments. And that's where we start getting into the tax breaks that we're going to talk about in more depth here. The non-refundable credits. If you've got kids and you've got them in daycare so that you can be in school or work, you could be getting a daycare credit. There's a couple of types of education credits. Tax breaks that you get as a result of money that you've spent or money that your parents have spent if you happen to be dependents on tuition and related fees and some other education expenses. Certain kinds of contributions to retirement plans can give you some non-refundable credits. If you have kids under 17, you can get a child tax credit too, for the ones that apply. If you're self-employed, you do, and you end up with a net profit, you've got to pay your share of the Social Security and Medicare taxes. That's happening automatic for those of you that have wages and you're paid on W-2, but it's not happening automatic when you're self-employed, so you have to deal with that. Payments, what counts on your behalf, withholding from wages. If you're self-employed, the IRS wants you to, if you're expecting to have a profit, to kick some money in at least 4 times a year so that you've made estimated payments. They like to get paid the same frequency that you're getting paid on your job. So that's one of their requirements. And then countable in this payment section is refundable credits. For really low income people, the earned income credit is actually a refundable credit, and that just means that it adds to their refund. It's a part of their payment. And one of the big education tax breaks has a portion that's refundable and a portion that's non-refundable. So that shows up in both places. So the bottom line, after you go through crunching all those numbers, you've either got a balance due or a refund, or you break even, meaning that nobody owes anybody anything. So before you can understand the main education-related tax breaks, a couple words about deductions and credits. Generally speaking, a tax break, and by the way, that's not an official IRS term, that's just the vernacular. It's an opportunity to reduce your tax liability because of some expense that you've incurred. You've spent some money, and they're going to let you take that into account somehow to reduce either your taxable income or the tax you have to pay. So one way is they let you count some of your income as not being taxable because it was spent for education expenses, for example. That would be a deduction. So one of the three big education tax breaks is a tuition and fee deduction. Let's say that you spent $2,000 for tuition. They're going to say, okay, that would have been taxable income, but we're going to let you reduce your taxable income by that amount. We're deducting that expense from your income. And the general way to figure out how much good that does you is the amount of the tax break. The actual bottom line benefit to you is to take that deduction amount, multiply it by the tax rate that you would have been paying taxes on if you had had to pay taxes on it. And so that $2,000 deduction, if you're in the lowest tax bracket, which is 10%, that saves you $200 on taxes. Okay, not bad. Not all that good though. When you get to the credit section, you'll see the difference. So of the credits, you've got the non-refundable and the refundable. If they say, well, okay, we figured your tax liability before any of these credits, but we see that you spent some money for tuition, fees, books, that kind of thing. And we've got a tax break, an education credit. The bottom line of that credit is the dollar amount of the credit is wiping out potentially the equal dollar amount of the taxes. Lifetime learning credit is one of the two credits. It's a non-refundable one. It allows you to count up to $10,000 of tuition and get a 20% credit, so that'd be $2,000. If you happen to have $2,000 worth of tax liability and you've got that $2,000 credit, you don't have $2,000 worth of tax liability. It just wipes that out. It's a dollar for dollar reduction in tax liability, not taxable income, tax liability. Now it says up to $2,000 because the fact that it's non-refundable means it can't really directly give you a refund. It only takes your tax liability down to zero. You can't have a negative tax liability and get a bigger refund as a result. So if you happen to have $1,000 tax liability and a $2,000 credit, well, you're going to use $1,000 of the credit and the other's just lost. Doesn't do you any good. So that's the non-refundable credits. The other version is refundable. And a portion of this American Opportunity Credit, which is the best of the education tax breaks, 40% of it, actually gets treated as a payment amount, which is a dollar amount in your favor, just like withholding, even if it's already wiped out all of your tax liability. So you could actually get a bigger refund as a result of having that after you get your tax liability down to zero. Obviously, the benefit is it's free money. It didn't come out of your paycheck. It just works the same way as if it had. So you want to say, well, what's the credit really worth, especially in comparison to a deduction? If you divide the dollar amount of the credit by the tax rate, it works backwards to give you the income that is effectively going untaxed. This is a way to kind of get some kind of equivalence for thinking purposes between a deduction and a credit. So a $2,000 credit, if you're in a 10% tax bracket, That's like saying, oh, okay, we're not going to count $20,000 worth of income. Think about that. That's a pretty big number, right? So you can see that a $2,000 credit is much better for you than a $2,000 deduction, because that $2,000 deduction was only saving you $200 on tax. The $2,000 credit saving you $2,000 on tax. All right, I'm going to give you a second to pause there in case you wanted to jot down a few questions that you might have about those things before we launch into the 3 major tax breaks that we're going to talk about today. Okay, so you've got 2 credits and 1 deduction. American Opportunity Credit, the best of the bunch, if you qualify for it. Lifetime Learning Credit, it's still a credit, so it's the second best of the 3. Just about anybody can qualify for it. It's not as restrictive as the American Opportunity Credit. And then the tuition and fees deduction, if you can't use any of the credits, getting the deductions better than nothing. The example that I gave on the other page actually happens to be, see the second bullet here, the $10,000 tuition cost. That's the most expenses that the lifetime learning credit will count. You could have had $20,000 worth of tuition, but they're only going to count 10, and the credit's 20%. So the maximum credit you can get out of that lifetime learning credit is $2,000. Oops. Okay, so here's the textbook kind of explanation of the American Opportunity Tax Credit, or American Opportunity Credit. The key thing down at the bottom of that screen is this can only be used for undergraduate expenses. So that's great if you're an undergrad. If you're already into grad school, the lifetime learning credit is going to be your starting point. And I didn't mention it there, but this AOC can only be used on 4 tax returns. So if anybody happened to take 5 calendar years or portions of 5 calendar years to get an undergraduate degree, you're not going to be able to use that American Opportunity Credit for all 5 of those years. You have to do it for 4 out of the 5. So it's useful to do a little bit of planning at the time you start taking this credit, and you can treat that as a homework opportunity to figure out how that would be to your advantage to do some planning, or you can contact some kind of a tax advisor and say, hey, wait a minute, what's this about? And I'll give you a hint up front, even though it probably doesn't apply to you guys now. If you're starting out at community college, it might be a good idea not to take the American Opportunity Credit for the first year there. Do something else. So just in case it takes you 4 years to, or more to get out of your undergraduate degree, you'll be able to use that American Opportunity Credit on more tax returns. Now here's the neat thing about the American Opportunity Credit, the second part of the screen over there on the right. It should have mentioned that it stops counting expenses at $4,000. Doesn't matter whether you paid $4,000 or $14,000 for your tuition, it stops counting at 4. But of that $4,000, the credit is 100% of the first $2,000, so that's $2,000. It's 25% of the next $2,000, which means the maximum credit is going to be $2,500. But hey, odds are that if unless you are a full-time employee or full-time self-employed in addition to going to school and fairly high income at that, you're probably not going to have $2,500 worth of income tax liability. So a $2,500 American Opportunity Credit is pretty much going to wipe out that tax liability for you. Okay, so let's say you're not a undergraduate anymore, heading out to grad school, med school, law school, anything after the first 4 years. Or let's say you're out in the workplace and you need to do some continuing education of some kind that you have to spend some money on. It works for that as well. if it's at an eligible education institution, which is pretty much any school that's participating in the Department of Education programs. No limit to number of years. Maximum credit is 2,000 per year based on 10,000 expenses at 20%. But as I mentioned in the previous slide, it's non-refundable. So if you only have $1,000 worth of tax liability, $2,000 worth of credit, you get $1,000 worth of benefit out of it, and you lose the rest because it cannot increase your refund on the excess unused part. I'm not gonna go in great detail through these unless somebody really wants to get into the details. You can raise that point in the chat over there. Tell me if you want to later go back and see these next two screens. I think it's two, yeah, well, three. On the left, various criteria and giving you the contrast between the American Opportunity Credit and the Lifetime Learning Credit. Another screen, same kind of thing going on. You can get these credits generally for yourself if you're married, for your spouse, or if you've got a dependent that happens to be a student that otherwise qualifies. Either the parent filing the tax return for a dependent or the dependent filing the tax return, well, no, not a dependent, a child, but not claimed as a dependent on a parent's return could claim and get the credit on their own tax return. Qualified expenses generally mean tuition, fees, course materials, books, supplies. A little bit of a difference between the two, American Opportunity and Lifetime Learning, as to whether those books and supplies have to be bought through the school or can be bought outside of the school. Let's go back to that first screen. There are some income limits on both of these, not the same limits, but the limit on, see where it says MAGI over on the left? The M stands for modified, so that's modified adjusted gross income. The IRS code doesn't like to leave well enough alone once they've defined a term. They like to be able to go back and modify it for subsequent purposes. In most cases, the modification doesn't affect anybody. But once you get into the higher income levels, it is likely that you start losing the availability of these credits. Okay. Qualifying expenses. Well, not everything counts. Tuition, fees, books, usually, supplies, a computer that you bought for school, in most cases count. Room and board, sorry. Transportation, you're on your own. Insurance, medical expenses, nah. Student fees, like recreation fees or some kind of entertainment or something like that, something that's not directly related to the school part of it. Unless it's a condition of enrollment, you don't get to count those. The red bar next to the bottom. If your tuition is being paid by a grant or fellowship or scholarship, some variation of free money, you can't count that as your expense for the purpose of these credits. That would be double dipping, and that's not allowed in the tax system. So if you happen to have $10,000 worth of tuition and fee expense, but you got a $5,000 grant from somewhere that paid half of that, your out-of-pocket expenses is the $5,000. And I say that loosely, out of pocket. If you took out student loans to eventually pay back those student loans and use the student loans to pay your share of those expenses, that still counts. You're ultimately responsible for that, and therefore it counts as your share of the expense. The expenses that don't count is the dollar amount that was paid by scholarships or grants or fellowships or things like that. And you can't double dip on tax breaks, so you got to choose between American Opportunity Credit or Lifetime Learning Credit or tuition and fees deduction. You can't use the same expenses for more than one of the tax breaks. A few words about the tax and fees deduction. I used that example earlier. The limit on the dollar amount of income that can be untaxed as a result of this is $4,000. So again, if you're in that lowest 10% tax break, saves you $400. Nowhere near the same as getting a $2,500 tax savings out of the American Opportunity Credit. How do you know how much was spent? How much was received? What it was spent for? If you haven't encountered one of these, it's time to get familiar with it. The 1098-T is in tuition, is the form that the school is required to provide to you that discloses key information that's used in determining your eligibility for the 2 credits, or for the deduction as well, tuition fee deduction. Somewhere in your online account at the school, you've got an accounting section, billing. Maybe within that is a tab called tax documents. Long ago and far away, they used to mail these things out. A lot of places don't mail them anymore, so it's up to you to go in and get those. And usually in the same area, sometimes even on the same page, if you find that 1098-T, scroll down a little bit farther and you may see the billing detail that is the list by school term, semester, quarter, whatever you got, of amounts that they billed you for tuition and other fees, and amounts that were received, whether it came from you sending a check or one of your grants paying off some money. And it gives the time and the date and the term it applies to. That billing detail is very useful to have when you're doing your tax return. So if you go in to generate the 1098-T on yourself, please do yourself and your tax pro, if you're using a tax pro, a really big, huge favor and print that billing detail out, because sometimes it makes it clear exactly what's in that list that they've been that they've picked up in the boxes below. And the key boxes are box 1 and box 5. 1 will show you how much the school says they've received as payments, and 5 is any of the free money you've gotten. And the difference between those 2 is the part that you were responsible for yourself or your parents. Paid through cash, check, money order, your own funds, your parent funds, student loans, whatever source it came from. Okay, the downside of receiving more free money than you had in qualified expenses. Let's flash back onto this. All right. Let's say that you spent $5,000 for tuition, but you got $6,000 worth of scholarships. Well, 5,000 box 1 minus 6,000 box 5 is a negative amount, meaning that you didn't have any of your own money in that deal. And depending on what other expenses, qualified expenses you can come up with that may not be included in this box 1 figure that the school has told you about, you may come up with another $1,000 worth of difference. If you didn't buy your books through the school, or if you bought them through the school, but they didn't count them in this record, and you know that because you got the billing detail, right? You can say, well, you know, I bought the laptop, I bought some books. Yeah, I spent another $2,000 beyond what the school's reporting there in box 1. Well, now you've got money in the deal here because you've got $2,000 not counted in 1. That offsets that extra $1,000 worth of grants. And now you're into the positive territory to where you can get a tax break instead of having excess money over the qualified expenses and therefore having to report it as taxable income. So there's a little textbook definition of scholarships, fellowships. Any of you that happen to get fellowships either from your school or from one of the associated places through Oak Ridge, Department of Energy, some of those other sources, once you get higher up, you may be getting some fellowships. In a lot of cases, that fellowship may end up being taxable. It may or may not be treated as an employee wages or self-employment. Once you get into those circumstances, you need to do some homework on your own and figure out exactly what the tax impacts of that are. And obviously, down at the bottom of the screen, if that 1098-T shows that you got more free money than you had the expenses reported in box 1, you need to do some research, as I just described, to figure out what other expenses you can throw into the mix there and keep from having to have taxable income as a result of those scholarships or grants. That's the highlights of the specific tax benefits related to college expenses. So again, I'm going to pause for a moment and let you note any questions you might have about that before we start talking about the stimulus payments. Okay, so the IRS calls it an economic impact payment. Everybody else calls it a stimulus payment. The point of it was to get some money back into the economy directly to people, let them have money to spend on bills. This is particularly for people who have had interruptions in their pay as a result of the coronavirus situation, but it's not limited to those. It's going to other people as well. Courtesy of the Congress and the President that passed the laws, hammered out all the details. There are eligibility requirements. Some people are not qualified to get it. Most citizens are. Bullet points up at the top, got to be a citizen or you could be a resident alien. Dependents, unfortunately, don't count directly, at least in terms of getting the payment themselves. Meaning a dependent on somebody else's income tax return. Got to have a social security number that's valid for employment. At the higher income levels, the stimulus payment is being phased out. Single person making more than $75,000 is not going to get the full $1,200. Single filer making more than $98,000 is not going to get any of the $1,200. If you happen to be over age 17, still being carried as a dependent on your parents' tax return, unfortunately, it's not going to do them any good. Your younger brother or sister that hadn't hit 17 yet is going to get $500 worth of stimulus payment to your parents, but apparently the way it's working out, once you've hit 17, even though you're still a dependent, you're not getting your parents, any break. On the other hand, if you're over 17 and you're in college and you're not being claimed as a dependent on somebody's tax return, you're entitled to the $1,200 payment in most cases, even if you're not employed, not working. If you have had income, you filed a tax return, they know who you are. If not, go to the IRS's website and go to the non-filer section and identify yourself to them and indicate that you're not a dependent. And that should get you in line for a payment on your own. And if you happen to be a college student that has dependents of your own, we're talking again about the under not having reached age 17 yet, then in addition to the $1,200 for yourself, $500 stimulus amount for each dependent that's of age. All right, so in general, as I've already said, $1,200 for adults, $500 for dependents. If you're married, filing a joint return, each of you get $1,200, so that's $2,400. The dependent has to be one of those relationships, basically blood relationship or related by marriage, stepchild, so to speak. Has to be claimed as dependent on your return, under age 17, citizen, valid social security number, or sometimes in the case of adoptions of international babies, I guess they may not have a Social Security number, but they may have another number that qualifies. Now, this is the most complicated part of it, because this is the place where the IRS's process has kind of, I don't know if it's fair to say that it's fallen apart. It never got put together right in the first place, I guess. Could well be some changes to this even as we speak. But the basic idea was supposed to be, if you've had if you filed a tax return, you had a refund, and you had that refund direct deposited to a bank account of some kind, the IRS already knows where to send you the money electronically, and that's what they're going to do. If you haven't filed a 2019 return yet, that's okay if you've done a 2018. Again, with refund and direct deposit. If you change bank accounts, stay tuned. If you didn't have a refund or you didn't get it by direct deposit, they've got a mailing address for you. They're going to send you a check in the mail. Even if you also receive Social Security or Railroad retirement benefits by direct deposit. If you didn't do a return in 18 or 19, or if you did a return but you didn't get direct deposit, you can go to the IRS's website, irs.gov, and there's one section for non-filers, not having filed a return in either of those years, to go to say, hey, I didn't have to file a tax return. I didn't have enough taxable income. I wasn't required to file, but I'm out here. I'm on my own. I'm not a dependent. Send me my stimulus payment. And there's also, under the Get My Payment link, a place where you can say basically, yeah, I filed, but I didn't have a refund, or I didn't get my refund direct deposit. Please don't mail it to me. Let me give you a bank info and send it to me electronically, direct deposit. If you haven't done that step yet, it might be worth trying to do that now. But the paper checks are going to start getting mailed out next week. It's going to take them several weeks because it takes a long time to print several million checks. They're going to start out in the first week mailing checks for stimulus payments to the lowest income people that they're aware of. And each week they'll pull in a slightly higher income level group of folks to mail those out, so that the higher income folks are going to have to wait longer to get those payments than the lower income people, who obviously can put the money to better use quicker. Are you going to have to pay this back next year? No. The actual details of this economic impact payment is actually going to be a 2020 tax return credit, meaning it's going to be a credit on the 2020 tax return, which you will be able to start filing in January of 2021. If what we're getting now is an advance payment of that credit, which also means if for whatever reasons you don't end up getting one of these stimulus payments by direct deposit or by check in the mail over the next few weeks or months, even for the rest of this year, but you're actually entitled to get it when you file a tax return in 2020, or when you go through that non-filer process. You can file that 2020 tax return and say, hey, I qualified, but I didn't get the money, send it to me now. So that's how you get it 8-9 months from now, if you didn't get it this year. And no, you don't have to pay it back. It's not a loan. It's not something that you're going to be income taxed on. It's not something you have to pay back. And under certain circumstances, even if you get an incorrect amount that's larger than you were entitled to, you may not have to pay back the difference. The real problem that's going on right now, a lot of people who file tax returns through retail preparers, such as H&R Block, Liberty Tax, Jackson Hewitt, TurboTax, may not want to pay preparation fees associated with doing those. That's assuming you're not actually doing a free return if you have prep fees. And those providers allow you, under certain circumstances, to have your preparation fees taken out of the actual refund when it comes from the IRS. But that involves a bank getting involved in the action in between the IRS and you, the taxpayer. That bank sets up a temporary bank account. The temporary bank account is what's provided to the IRS. The IRS sends your money, your refund, to the temporary bank account that's at that bank. That gives them access to the funds. They take out a fee for doing that. They take out the tax preparer's fee for doing your return. The net refund that's left over, they send to you. If you've given them direct deposit info for your own bank account, that's great. If you're using a debit card that bank provides, that's great. But the IRS doesn't know about that, because the IRS sent your tax refund to a temporary bank account that was there for the purpose of withholding of fees and was then closed by that bank. So if the IRS, which they have, tried to send some of these stimulus payments, it gets to that bank, and you'd think that the bank could say, oh, well, I've closed that account, but here, this person still has one of my debit cards, or I still know where this person lives. I'll forward that payment on to them. But no, it doesn't work that way. So most of those stimulus payments that come to the bank under that circumstance are just getting returned to the IRS. If you haven't gone in through the non-filer, or rather the Get My Payment section, to register a current bank account, then eventually you'll get your stimulus payment as a check in the mail once they get around to processing those. Unfortunately, there's no real way around that. You can try to do the Get My Payment to register a bank account. It may or may not have time to get put into place for them to send you that direct deposit money. And if it doesn't, you'll hopefully still get it as a check in the mail. All this information about stimulus payments is subject to change on a daily basis. If you go to the irs.gov, their main web page, there's last I looked at it earlier today, there's like 2 columns of 4 buttons each. I think the top one on the left is for non-filers to click to get in there to register that you're entitled to the stimulus even though you don't file a tax return. And the top one on the right is the Get My Payment, that will first determine if they have any information that they can say, yeah, we've already sent it, or you're going to be getting a check the week of April 24th. Or it might say, sorry, we don't have any specific information about you, but proceed, give us information about a current bank account, and we'll see if we can direct deposit the stimulus payment to your bank account. So that's the 2 steps that you can pick off of that irs.gov to get in on the stimulus payment action. And that is the end of the slideshow. Up on the top and the right, your starting point for homework on this subject, specifically the tax benefits for education. Go to irs.gov, do a search for publication 970. They've got a whole publication just like they do on many, many, many tax topics. This one's tax benefits for education. To the extent it changes from year to year, they will do an update for every year. So make sure you get the version that's for the tax year you're working on. And then your finishing point, if you don't want to do it yourself, you don't want to do your own tax return, you don't feel like you have a handle on it yet, there's my card. I'm pretty good at it, been doing it long enough. All the other fine tax pros at H&R Block. And there's plenty of other places you can go. There's CPAs, there's our competition out there, the other retail, as they're called, tax prep offices. You know, your Aunt Mary might do some of these on the side. Good luck with that. And that's it. In terms of follow-up, the 2020 tax season, which is what it's called right now because we're doing it in the calendar year 2020, so it's the 2020 tax season, but it's the 2019 tax year that we're doing tax returns for. That season has been extended from April 15th July 15th. The July 15th is the deadline for filing a tax return without having any kinds of late penalties or fees. It's also the deadline for paying if you have a balance due without any kinds of interest or penalties for late payment. As a result of that, H&R Block has extended their processing season through July 15th. At least that's the figure or the date we're using right now. So about a third of our offices in the Knoxville area are still open with reduced staffing. My office happens to be one of those, and at most we usually have 2 people working in the office. Unfortunately, right now we're getting an awful lot of phone calls, people asking about the stimulus payments. Once that kind of levels out, we'll be open for business, just doing tax returns and helping people understand what's going on that. If you really have some follow-up questions that you really need urgent help on, there's my email address, my office phone number. You're welcome to give me a call. We do basic kind of consultations at no fee. We only charge a fee if we actually do a return. And that is the end of my part of the presentation.
Awesome, Doug. Thank you. We do have a question from one of the students on right now. They are an international graduate student who has been working as a GRA for their department for the past 5 years. They became a resident alien as of the 2019 tax cycle. They paid all their taxes up until 2018, but they're in the process of filing taxes for 2019. Would they be eligible for the stimulus payment? And I'm looking, they have another part to that. Almost all of their fees are covered by the GRA. They only pay a certain amount out of pocket for the semester, and can they count it in tax credits?
Yes, if your expenses, if you have some college-related expenses that are paid out of pocket or through student loans, above and beyond whatever that grant situation you're talking about, yes, it potentially qualifies. And now the potential part of that is going back to the first part. Okay, so we've got an international student. I will confess that one of my weaker areas is the international students. Let's see if I can backtrack. I don't think these actually address that. Let's see, student. What I'm looking at is the whole Social Security or ITIN, which is an International Taxpayer ID number. Under the circumstances that the questioner described, I think that questioner probably has an actual Social Security number. And I suspect that it is a Social Security number that is considered valid for employment. Some Social Security numbers, particularly international residents, non-residents, are given Social Security numbers for purposes of doing things like filing a tax return, but not necessarily for employment. And I know that sounds a little contradictory, but I'm not going to get into the details there. So if you have an ITIN, meaning you have not gotten a Social Security number yet, no, it's unlikely that you could qualify for this. If you have a Social Security number, an actual Social Security card that's valid for employment, yes. But go back to the first part of all this. A tax credit, like these two we're looking at here, or which way am I going? Still can't get used to which is front way and which is back on this. Or the tuition fees deduction, the education benefits only do you any good if you have taxable income. So if the questioner is single and has less than $12,200 of potentially taxable income for the year, they don't have tax liability. A credit's not going to, the non-refundable credit's not going to do them any good. but the refundable portion of the American Opportunity Credit might do them good if they're undergraduate, but I think you said this questioner was a grad student. So short answer is you probably need a Social Security number that's valid for employment. And then you've got the grad school versus undergrad, and that drives you to the American Opportunity Credit or the Lifetime Learning Credit. But the Lifetime Learning Credit is not going to do you any good unless you have tax liability. No refund out of that. American Opportunity Credit, 40% of that can just come into your pocket as a refund. I would recommend going to that Pub 970, I think, to look that question up. Yes. Any more questions?
What are the most common questions that you're receiving right now, Doug? I know there have been a lot of changes with tax deadlines, with the stimulus payments, and so on and so forth. What are the most common things that you're hearing?
Well, everybody's kind of gotten used to the whole extension of the tax season now to July 15th. Some people are still not clear whether that's extending the filing deadline or the paying deadline. Because in the past, you've been able to get an automatic extension on the filing deadline from April 15th to October 15th, but that was not an extension on the paying deadline. So you kind of had to get a rough idea as to whether you had any balance due and go ahead and pay that even if you're not filing your tax return yet. But this time is different. Both the filing deadline and the paying deadline have been extended until July 15th. So for example, today I did a return for a couple that owed a couple $1,000. We filed the tax return today, no reason to wait around, it was done. But they owed, close to $3,000 actually, and they didn't really want to pay that right away. So they were able to pick a payment date anytime between now and July the 15th. And they did choose a date that's a little bit farther down the road, and they set it up for the IRS to just reach into their bank account, take that payment on the specified date. That's the most question about that. Let's see. A lot of people are still confused over the stimulus payments. Most people are kind of getting a handle on how much they're going to get, if they're getting anything. The real problem is the folks, as I described, that they had tax prep fees at a retail preparer taken out of the refund itself, which means that there was a temporary bank account in between the money they got and the IRS that sent out that refund. And there's a lot of unhappy people over that. In some cases, Block has been able to intervene with the bank that handles that for us, and have instances where the IRS sent the money to the bank and Block was able to work to the bank and get that stimulus payment forwarded onto the right place for that client. But for the most part, that's not happening. So there's a lot of disappointment over that, but that's not something that the retail preparers can, or preparation companies can deal with. Nobody saw this coming. It's just the way things worked out. If you pay your prep fees up front directly to the preparer, you can get the money direct from the IRS to your bank account, and there's nothing in between. People that don't have the cash flow to do that have been happy all these years taking advantage of that fees withheld, even though the bank charges a fee for doing that. Our bank charges $40. Some of the other banks that do that charge $50 or $60. But right now it's coming to bite them. In terms of tax returns themselves, there's a extreme amount of ignorance as to how the whole process works. Even people that have been doing taxes now for years, through me, for example, because that's the only ones I have direct experience with. I find myself each year reminding him of some of the same facts as to how everything works, how self-employment works, how if you've got a profit from self-employment, you've got to pay your share of Social Security and Medicare taxes because you don't have an employee that's getting the money with, out of your paycheck to file that for you. And that's why I think the brief overview I gave at the beginning that says this is how the whole system works. It's good if you would refer back to that at some point, or just get a copy of the 2 pages of the 1040 and look at how it's laid out. And it's kind of laid out in sections along those same ways. There's an income section, an adjustment section, deductions, there's taxable income, there's tax brackets, there's tax liability, there's credits of the various types, and there's payments, and there's other taxes. So they're all laid out there. And if you get the whole idea of the flow and how it works, it makes the other things that you encounter in the process of doing the return make a whole lot more sense. So I would encourage people to study that a little bit once they start having to do a tax return. Be real careful about the 1098T and the situation where you've actually received more in scholarships or grants than you had listed in box 1 as the expenses, because that box 1 is only the expenses that the school is aware of. If you bought a computer somewhere or bought books, outside the school's library, or school bookstore, if that even exists anymore, dig down deeper into the rules for what kind of expenses are qualifying expenses, and see if you can flip it from taxable grant or scholarship to non-taxed, which means that you then have a net out-of-pocket expense, which you can then possibly get some kind of an education tax break on. That's the most common things I can think of right now, just in terms of general tax return questions that might be relevant to the audience today. Ask me some more questions. I'll see if I can come up with another.
That's actually all that we had for today. But just as a reminder to anyone who may be listening, don't forget to follow the Center for Student Engagement at UTK-CSE to find out about all of our events and programs that we have throughout the year. It's the easiest way to keep in touch with us and know about events such as adulting. So I want to thank you again, Doug, for taking some time this afternoon just to talk with us about tax benefits and tax information for anyone who may be listening to go ahead and complete that. I know we're kind of in strange times right now, and so any updates are extremely helpful. So again, I thank you and appreciate you and your team at H&R Block for taking some time today.
You're very welcome. Happy to do it.